2022, December 2022, question number 3R. So please start looking for this question as I introduce my great topic here called Modigliani and Miller. Modigliani and Modigliani. So remember, this is Franco Modigliani. Yeah. And then we have in this case here, Modigliani Miller. Yeah, there were two friends in this case here who came up with very good propositions here, very good proposition. And they were related. They were related. So then allow me to rub this. Modigliani and Modigliani. This same Modigliani guy even went ahead to do research with the daughter, which they called Modigliani and Modigliani, that is Franco Modigliani and Lea Modigliani. So he was really a serious researcher, and I'll be able to make reference to some handout, which I'll be able to use here throughout. I hope you got the handout right. So, and we are going straight away to page number 27. Page number 27. So you can either call this Modigliani and Miller, Modigliani and Modigliani, one and the same. So we start, ladies and gentlemen, straight away with page number 27. Share. Yeah. So this is the one we are looking at. So we start with Modigliani and Miller propositions, or Modigliani and Modigliani propositions. And we are starting with MM1 without taxes, which is also known as net operating income. NOI. Page number 27. I hope we shall be able to get it very fast. Net operating income approach. It's not there. It shall be there. Net operating income. So let me start by asking you great guys a question. Whenever you hear of operating income, what comes to your mind? You as a finance scholar, what is operating income? You know, we have various profits. We have profit after tax. We have profit before depreciation and tax. We have so many types of profits. So this profit that they call operating profit is which profit? It is profit before interest and tax. So whenever you hear of operating income approach or NOI approach, always know that we shall be using what we call profit before interest and what here? Tax, which we also abbreviate as EBT. EBIT, which also abbreviate as EBIT. So please, you can write somewhere like that. Yeah. And then I would want us straight away to go to the assumptions of MM1. These are the paragraphs I'll always leave you to do, to read them later. Yeah. So underlying assumptions of MM1, these are highly examinable. Your examiner will always ask you about these assumptions, and I would want you to master only three. Only three. The first one is that there are no taxes, neither corporate nor what here? Personal. No taxes at all. Under MM1, no taxes at all. And then we have a second assumption here. Investors and firms can borrow and lend at the same rate of what here? Interest. Meaning that rate of interest is only in advance and will remain the same, regardless whether you are borrowing or you are lending. So basically, this is a model of zero profits here for the banks. Then number 3, perfect capital markets. There are no transaction costs, no flotation, nor whatever bankruptcy. Investors have equal access to information. The expected EBIT or operating income of the firm is constant and what year? Perpetual. All right. Then business risk is constant. The firm's risk class is not affected by financing what year? Decisions. So amongst those many assumptions, which assumptions are you likely not to forget? I will never forget number 1, that this is a model of what year? Zero taxes. Zero taxes. No taxes at all. And then the concept of transaction costs are always zero. We don't have in transaction cost. If you walk into a bank, they'll not tell you that, hey, for you to borrow this loan, you need to charge an asset, and the charging fees offered by lawyers, etc., 100,000, those expenses shall never be there. All right. Then there is one concept that students in this case here forget all the time, that this EBIT EBIT here, this operational income is known in advance and will remain constant. And it's going to be there perpetually. You understand the concept of perpetuity? Let me ask you a question. Assuming somebody in this case here promises to give you 10 million Kenya shillings per annum, and the N is infinity, and the R happens to be 10%. Are you able to give me the present value in this situation when N is infinity? Are you able to give me the present value in this situation? Somebody is promising to give you every year 10 million Kenya shillings every year, number of years, infinite. All right, R is 10%. So then what is the present value when N is infinity? Are you able to remember the formula? Yeah, we will take something divided by something, isn't it? We shall take something divided by something. We shall take something divided by something. So we shall take something. Something is this annual amount. So we shall take this annual amount. We divide this by what here? Somebody by this required return, isn't it? So the annual amount in this case here will be 10 million divided by 0.1, which gives us what here? Somebody? Which gives us 100 million. We shall use the same concept whenever it comes to valuing an organization using Modigliani and Miller 1. Because under Modigliani and Miller 1, firm value, please listen to me. Firm value will be this EBIT, we divide by what are the required return. So because there are no taxes at all, we simply take our net operating income, which is EBIT, we divide by R. And of course, as we shall be seeing, R will be the cost of what here? Cost of equity? Cost of equity. So then with your permission, now having mastered those many assumptions, of course, I've told you to master only 3. I will now be able to go ahead to the demonstrations. We go to a question, which happens to be on this handout, which I don't know. Yeah. So the main proposition, as you shall be seeing, is that whether you are levered, whether you have debt or not, the firm value will always remain constant. As you shall be able to see under MM1, ladies and gentlemen, the proposition that they did here, the proposal that they have here is that the firm value will remain constant. And for us to be able to prove that within 2 minutes, we shall be able to look at this illustration, MM1 without taxes. So MM1 without taxes on page number, this is still page number 27, On page number 27, we are told down there, the middle, MM1 without taxes. Example, 2 farms. A is unlevered. Unlevered means what? No debt. Unlevered is the same as ungeared, no debt. And then B is levered. B has got debt in it. They are identical except for their capital structures. So you can see the particulars there. Farm A, which is unlevered, has an EBIT of 1 million here. And this farm A, you can see debt there is 0. But it happens to be having WACC of 15%. Taxes 0. Farm B, you can see EBIT there is 1 million. All right. And then you can see debt. It has debt 4 million. And then you can see WACC has been given as 15% as well. Taxes 0. So they want us to do something very easy. They want us to compute farm value. And that is where now my class begins. We compute farm value using MM1. So using MM1, what is farm value? Farm value. So remember, we are looking at MM1 first. MM1. So under MM1, farm value, and we shall start with farm A. Farm A. What have we been told about farm A? It is unlevered. Unlevered means 0 what here, somebody? 0 debt. Unlevered means 0 debt. And remember just how we were doing this Gachagwa's model. To value an organization, we are looking at the return. We are looking at the return. The return coming from this organization is EBIT. Remember, MM1, we use EBIT. We use EBIT. You can write somewhere there. We use EBIT to value organizations. 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 And since this organization will be with us forever in perpetuity, then farm value, we'll call it value of unlevered farm. Because it's unlevered, it will be EBIT divided by our rate of return, which will be to us. It's called the 𝑤𝒊𝒅𝒆𝒐. Because you see, the investors, they call it a return. We in the company, we call it a cost of capital. So farm value, you can write this in full that this is value of unlevered farm. Value of unlevered farm. So in this question, are you guys able to see the EBIT? Earnings before interest and tax. Are you able to see the EBIT? EBIT is $1 million, isn't it? $1 million. So then we shall be able to come and divide this by the WACC given. WACC, which in this case here they have told me is 15%. So 1 million divided by 0.15, this will end up giving us a what figure? This will end up giving us a what figure? Quite an ugly figure, right? Which is what here? 6 million, right? So this gives us 6 million. Yeah, 666, like that, right? Yeah, Kenya shillings. So that farm value is worth 6. The farm itself is worth 6,666,667, like that. Now remember, under MM1, very, very important, you can double underline there, value of unlevered farm will always be equal to value of what here? A levered farm. Please write this in full now that you're starting to do this, that this VL stands for value of what here, somebody? A levered farm. A levered farm. A farm with debt in its capital structure. A farm that has got debt in its capital structure. Wanafunzi online wamenyamaza sana leo. I don't know why they are this quiet. Of course, I know. Most of the times, whenever people hear about Modigliani Miller, they simply, get like, this is a tough area. Trust you me with me, this is a straightforward area. There's nothing here. So be happy. Just like how you are always happy. Yeah, great. Thank you so much. So in this case here, with an MM1, value of unlevered farm will always be equal to value of what here, somebody? A levered organization. Yeah. So meaning that farm B, which is a levered farm, will also have its value being equal to how much here, somebody we are following. Yeah. The same. It doesn't matter how they want to cheat you, so long as they have told you that you are valuing this organization under the environment of MM1. The organizations given there will always have the same farm value, will always have the same farm value. So, and if you try to prove this, you can come and tell us it regardless. If it is MM1, to get value of a levered farm, I will still take EBIT. I divide this by W, what here, somebody? ACC. What is the EBIT of this levered organization? It's still 1 million, isn't it? Yeah, and I need to give these online students this handout now. You can see here, the levered farm has got EBIT of 1 million. EBIT does not change. So EBIT is 1 million and the WACC is still 1.15, isn't it? Which still will end up giving us 66.6 like that. This is really important for us to appreciate from the word go. And you can see the conclusion under MM1, ladies and gentlemen, the conclusion under MM1, the most important conclusion is that both farms have identical total values, proving that leverage has no effect on the overall what year value. The debt will not be able to give you a push. Remember, ordinarily, as I will be able to prove to you here, ladies and gentlemen, in life, even as a company or as an individual, debt is supposed to push you up there. If you know how to utilize debt money, debt is supposed to really give you an advantage. That is what we call leverage. Yeah, when you are geared you tend to move much faster than a vehicle, in this case here, that has got lower gear or no gear at all. The one that has got no gear at all will not be able to move from point A to point B. Now, there is another concept I want to show you. Another concept I want to show you. How do we get to value this organization using method 2? So using method 2, ladies and gentlemen, for valuing a levered organization, anytime you see an examiner asking you to value a levered organization, we shall always take value of unlevered plus value of unlevered plus D times T. Anytime they want you to provide value of a levered organization, you shall always take, ladies and gentlemen, value of unlevered plus the debt which you have in your capital structure times the tax. So like in this particular case, the levered value will be equal to the unlevered value, which was this. Can somebody tell me this farm 2, farm B, what debt amount does it have? 4 million, isn't it? It has a debt amount of 4 million. A debt amount of 4 million. If you look at the capital structure, the debt amount here is 4 million. So you take the whole debt amount, which is 4 million, and then you multiply this by T. Are you able to remind Mwalimu what tax is here? 30%? No, but we have just said in a few minutes ago that there are 0 taxes here. MM1 tax is always 0. MM1 tax is always 0. MM1 tax is always 0. MM1 tax is always 0, yes. So then this will give me value of a levered farm, which will still now remain at 666, 6667, like that. Great. So let me come here and try to give these students this handout so that they can also be at a leverage position. Are you able to get up? Oh, great. Thank you so much. Because the risk could have been you passing in front of my camera. You may come late and then you tell me, Mwalimu, don't put that camera up on your social media or wherever. All right. Let me just upload this document here so that these students don't follow me after class for notes. Great. AFM. So please confirm that now you are able to see the handout. And as usual, once you get it, ensure that no. This is a very different one, Acha. I always keep on updating my handout. Please, Acha, pick this one. Pick this one. I know what you are talking about. My colleague here sent, if that is the case, then you have the correct one, yes. You have the correct one. So then I should be able to continue to what we call MM2, right there, title, MM2. So remember MM2, now we have got what here? Corporate taxes. Now here we have corporate taxes. We have corporate taxes. And from this handout, ladies and gentlemen, that I'm going to pick here, when we talk of this MM2, then what comes, ladies and gentlemen, to our mind? Very easy concept. Nobody should ever get a fail in this paper. Page number 27, right? So MM2, page number 27. So MM2 page number 27, there we are. There we are. We are told, my good students, here under MM2, that with corporate taxes, in the original model of ignore taxation. In 1963, they amended the model to include corporation tax. This alteration changes the implication of the analysis significantly. The most important thing, ladies and gentlemen, is that under this third paragraph, that geared companies, under the third paragraph, the most important concept here under the third paragraph is that geared companies have an advantage over ungeared companies. So the companies with loans, they're always better off with than companies without loans, i.e. they pay less tax and will therefore have a greater market value and a lower 𝑽𝒊𝒅𝒆𝒐. So we go to a question right away before we go to the past paper question, which I had hinted to you that shall be doing right away. There is illustration 1 given down there. Illustration 1, consider the two firms, L and U, with the following features. EBIT is $1 million. They have given us cost of equity 10%, 10% for the two firms. 8% debt, I can see the firm with the L, which stands for levered, has a debt amount of 5 million. And then levered has a debt amount of what is 0. Tax rates have been provided. So that they want us to calculate the value of each firm under the WACC. So I'm doing firm valuation under Modigliani Miller 2 because here I happen to be having corporation tax. So, and if it is MM2, then what do we do? This is really, really easy, very easy. So MM2, basic steps of MM2. Basic steps of MM2. Basic steps of MM2. So basic steps. So the basic steps, number 1, you ascertain value of unlevered firm. That is what you do. You ascertain value of unlevered firm. That is very, very important. And you shall always follow these steps religiously. Then number 2, you ascertain VL. How do you get VL? You use the firm value you got up here, which is VU plus DT, like that. Yeah, VL, you get VL, yeah, which will be VU plus debt times taxation, times taxation, times taxation. Yeah, somebody should be able to answer purity. Yeah, we have only done MM1, now we are doing MM2. We are rent, and you can leave like half a page. And then number 3, ladies and gentlemen, you determine the weights. You determine weights here. Which weights do you get? You get weight of equity and the weight of debt in the capital structure. You determine weights. After that, my good students, you get cost of equity of a levered firm. Of a levered firm. Cost of equity of a levered firm. What we call KEL. What we call KEL. You get cost of equity of a levered firm, what we call KEL. And to be able to get KEL, you will always take Q plus into brackets Q minus KD. D over T into 1 minus taxation. These formulas at times they scare students, but there is nothing there. Totally nothing. So if they want you to get KEL, we shall be taking Q plus Q minus KD into D over T, 1 minus tax, like that. And then now lastly, you can now comfortably give us what we call WACC. You can comfortably give us WACC. I forgot to give you one formula. This formula, ladies and gentlemen, of getting value of unlevered, it will be EBIT, and then you take away tax. You divide by Q. So anytime you want to get value of unlevered, you take EBIT, take away taxation. And then you divide everything by Q. Remember, when we began, we said that these organizations will be staying with us forever. And we are using EBIT to value them, So I don't know whether I've been able to write all these formulas. So now I can take a minute to show you what these symbols mean as I do the question. So have you finished writing all this? Can we use KE in place of WSCC? No, you see NOE method, which is MM1, shall always make use of WSCC. And I'll be able to explain why. Always. I'll be able to explain why. Later, but in a nutshell, remember when you talk of EBIT, it means that this belongs to two stakeholders. Yeah, we have an income here for the debt holders, known as what here? Interest. And then we have an income here for the equity holders. That is why in this case here, because there are two of them, then you shall always divide here by what? Here by? You see, now when we talk of weighted average cost of capital, we know that here we have weight of equity, cost of equity, weight of debt, cost of debt. So this takes care of the two stakeholders. Always for MM1, we shall always use WACC. And that was a very good question, because I've also seen in the past paper where the examiner gives you Q and then he gives you WACC, and then he asks you to get MM1 value. MM1 value shall always make use of WACC. And I will also be able to prove to you something different here later, that you see WACC over a farm that is unlevered will be exactly equal to cost of equity of that farm. But let's not complicate things right now. Let's first of all do this question that we have. All right. So we start with step number 1. So step number 1, they have given us two organizations. Let's first of all ask ourselves which one is unlevered, and let's get to value it. So you can see we have an unlevered farm, right? This unlevered farm, let's value it. So how do we value it? Already I've written the formula. You guys have to write this formula. So talk of value of unlevered farm. I can see EBIT is 1 million times 0.7 over cost of equity of the unlevered farm, which is 0.1. Remember, Q stands for cost of equity of unlevered farm. Cost of equity of unlevered farm. I'm so sure you guys haven't yet seen where I got 0.7. If you have seen where I got 0.7, I should give you a present. I'm 100% sure they haven't seen. Is there anybody who has been able to see where we got 1 minus 30%? 1 minus tax, isn't it? Yeah, 1 minus tax here, because you see tax in this question is 0.3. Therefore, 1 minus this tax, it will be 1 minus 0.3, which gives us 0. What here? 0.7. So is there somebody who is then able to give me value of unlevered farm? Anybody who is able to give me value of unlevered farm? Thanks, Goret. Yeah, great. So value of unlevered farm, what figure are you getting at the end of the day here? 7 million, eh? Yeah, the online students, are they able to get that 7 million? Online ninjas, are they able to get the 7 million? The online ninjas, are they able to get the 7 million? Yeah, so this is 7 million, like that. 7 million, like that. Thank you so much. Now, ladies and gentlemen, after that, we go to the second step, which is now valuation of the other farm. What we call value of what here, somebody? Value of a levered organization. So here, this is where majority of the students will go wrong, because they'll start talking of EBIT. No. When it comes to a levered organization always stands on the unlevered farm. So to be able to get value of a levered farm, you shall always take value of unlevered plus DT, like that. Value of unlevered plus DT. Meaning, ladies and gentlemen, that value of our levered farm will be equal to value of unlevered, which is 7 million. Are you able to see the debt amount in the question? Are you able to see the debt amount? How much debt does this levered farm? 5 million, right? 5 million. The online ninjas, they also have the handout. Are they able to see the 5 million? 5 million. Thank you very much. So 5 million times not 1 minus tax, but times tax. And tax is 0. What here, somebody? 0.3. Tax is 0.3. Tax is 0.3. Tax is 0.3. Tax is 0.3. So Tyne is able to give me a figure of what here? 8.5 million. Where is Lincoln today? Today I can't see Lincoln. Where is he today? Where is Lincoln today? This is very unusual. We shall overcome, right? We shall overcome. We shall overcome. 8.5 million. Now, ladies and gentlemen, from there now straight away, you'll get ahead and they give us weights of the levered farm. You give us weights of the levered farm, of the levered farm. Weights of the levered farm. Weights of the levered farm. So to give us weights of the levered farm, this is really, really easy. What do? You know the total value. Let me see here. We know the total value. We know the total value. So we know the total value. So the total value of this levered organization is 8 point what here, somebody? 8.5 million, isn't it? This total value, we break it down to debt and equity. Debt and equity. You break it down like that. Yeah. Debt is always constant. Are you able to remember the debt amount? You guys gave me a debt amount of 5 million. So then the equity amount will be the difference because the two must add up to the total value. Yeah, equity will be the difference. So that gives me 3.5 million. 3.5 million. 3.5 million. So therefore, in terms of weights, this is million. In terms of weights, because weights are proportions. Remember, weights are proportions. So it means that debt will be 5 million over 8.5 million, and equity will be 3.5 million over 8 point what here, somebody? 8.5 million. Therefore, weight of debt will be equal to what here? 5 million over 8.5 million over the total. Over the total. So weight of debt will be 0 point something. Please give me 2 or 3 decimal places. So this breakdown at times disturbs students, and really it's very, very easy. The moment you know the debt amount, getting equity should be complementary. Equity should always be complementary. And then now you change this to, you can write here WD equals, this is WE equals. So come and give me the weight of debt, which is 5 million divided by 8.5 million. 0 point. 0.588. 0.588, like that. How about weight of equity? Weight of equity, I will either get it by dividing or by saying 1 minus this. 0.41, 412, like that. So the online ninjas, are they able to get this? The online ninjas, are they able to get this figure? The online ninjas, are they able to get this figure? Thank you so much. So we go to the second last step. Second last step, come and give us cost of equity over a levered organization. Cost of equity of a levered organization. Cost of equity of a levered organization. So cost of equity of a levered organization, what the examiner will always do, and this one I can bet with all my heart, what the examiner will always do, he will come and cheat you. You can see in this case here, under cost of equity, levered, they've given you 10%. And the cost of equity and levered as well, they have given you 10%. It's not possible. That cost of equity levered is fake. It cannot be the same with the cost of equity of unlevered, because me as an ordinary shareholder, if I realize that your firm is highly indebted, For me to give you my money, I will ask in this case here for a higher return, a higher return, a higher return. So then that cost of equity there is fake. So always under Modigliani-Miller 2, Modigliani-Miller 2, they told us always to use their formula for getting cost of equity of a levered farm. And in this case here, this will be KU plus KU minus KD into D over T, and then D over E. I must have written this badly. It is D over E, not D over T. It's D over E. Please look at the steps and make amendments there. It is D over E, debt over equity, into 1 minus what here, somebody? Into 1 minus taxation. Under Modigliani-Miller 2, you shall always use this formula to get cost of equity of a levered farm, regardless of what the examiner gives you as cost of equity of that farm. We shall always use this formula. Always. All right. Then with your permission, ladies and gentlemen, I would want us to substitute here. So fortunately, we have an unlevered farm whose cost of equity was 10%. Isn't it? Unlevered farm, what is the cost of equity there? It is 10%, isn't it? Plus into bracket, cost of equity unlevered farm is still 10%. Minus the loan there. Are you able to see the coupon rate of the loan? Are you able to see the coupon rate of the loan? The interest rate, 8%. 8%, yes. 8%. When I broke down my components, I got debt of 5 million and equity of 3.5 million. When I did the breakdown, 5 million over 3.5 million. Yeah. Times 1 minus tax. 1 minus tax, that is 0. What here, somebody? That is 0.7. 1 minus tax, that gives me 0.7. So here you have to do your abracadabra. You must really engage your calculator very well. You say here equals, you say 0.1 plus, open brackets, 0.1 minus 0.08. You close. You say times 5 over 3.5, or times 5 million over 3.5 million times 0.71 equals. 1 equals, you should be able to give us, ladies and gentlemen, this scale. Remove slowly. First of all, get whatever we have here inside brackets. And then you multiply it with this quotient times 0.7, and then the answer you add it to 10 what here? You add it to 10%. Where did I get the 3.5 million from? Remember, this was the total value of the farm. And this same value has got a debt of 5 million. So automatically, remember, as we shall be seeing when we continue, farm value will always be equal to debt plus what here, somebody? Equity. Farm value. If you look at, for example, RCM, ladies and gentlemen, here, whatever assets we have, these assets will always have 2 owners. Equity owners, the shareholders must have put in some money, and there must be a bank involved. So any farm valuation, you guys are accountants, where you're working, whenever you look at the assets of the farm, they'll always have 2 financials, debt and what here? Equity. So then when I know that the farm value is 8.5 million, and I know debt is 5 million, to get equity, I will take 8.5 minus this. That's how we got the 3.5. I hope now you are okay. I hope now you are okay. That ninja was asked that question. I hope you are okay. All right, thank you so much. So is there somebody who is able to get something like 12%? 12%, yes. 12%, 12%, 12%, 12%, 12%. And now lastly, you can give us the WACC. Give us the WACC for a levered farm. WACC for this levered organization. I'm so sure that you will be able to do that very well. You'll be able to do that very well. You'll be able to do that very well. WACC of a levered organization. So remember that WACC is Weke plus WD KD into 1 minus T. And fortunately, now you guys have everything. You guys now have everything really to give us WACC, yes. You have all the weights. Do you remember the weights that you guys were able to give me, like weight of equity? You gave me 0.411 or 12. 12. Cost of equity is this cost of equity of a levered farm, 12%. This weight of debt was 0.588. Cost of debt is the rate of interest. Cost of debt, you guys gave me this. It is 8%, isn't it? And then 1 minus t, this one we are so much accustomed to it. It is 0.7 like that. Please feel free to ask questions. You shall always feel free to ask your father as many questions as possible. You shall always be very free with your father, even more than how free you are with your mother. Yes. Or who are you supposed to be very free with, your father or your mother? It depends with what? Nothing. Always father number one. Father number. All right. So what figure are we able to get? I can see some online student telling me that Mwalimu, this WACC, Mercy is saying that you should, be very free with both of them. Okay. I agree. Okay. But first, give me WACC. Give me WACC. Six point something? 6 point? I'm being given a figure of 6.75. 6.75%. The online ninjas, I can't see them getting this figure. I can see somebody who has gotten 6.178. I don't know how they got it. 𝐻𝒊𝒆𝒔𝒕 is getting 0.08. Okay. So I know the mistake that so many ninjas will do. They'll put a bracket here as if this 0.7 is affecting what? Which is wrong. Please just get your calculator, press 0.412 times 12%, which is the same as 0.12, isn't it? You say plus 0.588 times 0.08 times 0.7, and then you will be able to see that this correct answer is supposed to be 0.08. 24, 24 like that, which is the same as 8.24%. Please repeat, because you have realized so many of you are giving me very, very different answers. There's a ninja who got 6.1 something. Other ninjas got 6.75. Goretti says 8.24%. So is that okay? Yeah. And then I'll go ahead and give us a summary. You shall always give us a summary. You shall always give us a summary. Always give us a summary. Always, you shall give us a summary. Always. So the summary, we have our farms. Give us, in this case here, farm value, give us WACC. So farms, we have unlevered, we have levered. So unlevered, what is the farm value that you gave? 7 million. Unlevered, you give me a farm value of 7 million. Levered, you give me a farm value of 7 million. The U, you give me a figure of 7 million. And then levered, the L, what figure do you give me for the total value? 8 point. Yes, what the WACC of the levered farm was. It is still here. WACC of the levered farm is 8.24%. Yeah. And how about unlevered farm? Unlevered farm, you're supposed to remember that WASHU will always be equal to KU. Always WASHU, WACC over unlevered farm will always be equal to cost of equity over unlevered farm. You don't have to calculate it at all. Don't waste your time. WASHU will always be equal to KU. Are you able to remind us what the KU figure was? Anybody who is able to remind us what the KU figure was? 10%, isn't it? 10%. Achieng, I don't know how you got 8.5. Achieng, oh, this one here. Thank you so much. Yeah, you're trying to respond to this. Thank you so much. So in all respects, between the two organizations, which farm is better than the other? The levered farm has a higher value and it has a lower WACC. So in this case, you tell us there that the levered farm is better than the unlevered farm. The levered farm is better than the unlevered farm. Levered farm is better than the unlevered farm since it has a higher farm value. It has a higher farm value and a lower WACC. And a lower WACC. Remember, as a finance manager at your workplace, you shall always fight with WACC to reduce, because it's through reducing WACC that your farm value increases. So you're saying in all respects, the levered farm is better than the unlevered farm, which angles here that the farm value of the levered farm is higher than the farm value of the unlevered. And then the weighted average cost of capital of the levered is lower than the weighted average cost of capital of unlevered. What do you think has been able to give this levered organization an upper hand? What do you think has been able to give this levered organization an upper hand? Is it because it has got very superior managers? No, it is because it has got debt. Debt is good. Even in this classroom, if you were to take stock, trust you me, somebody who is levered, somebody who has got loan, lives a better life than somebody who does not have a loan. Or that is debatable. How do you progress in life without loans? You cannot. You cannot. Thank you so much. So then, ladies and gentlemen, Olikolin has just arrived here, and the first statement is making there is that these are lies. But now, Olikolin, remember, you are still a young man. You are still a very young man. You may not be able to understand some things. You shall overcome, don't worry. You shall overcome. So then, we look at our past paper question, December 2022, question number 3A. December 2022, question number 3A. December 2022, question number 3A. And I shall be able to give you how many minutes to do this question? December 2022, question number 3A. December 2022, question number 3A. I will give you exactly 10 minutes during our prayer time as well, and ensure that you are able to do this question. The name of the question is, it doesn't have a name actually. It is two farms A and B are in the same industry. So ensure you get this correct, and then I'll be able to give you a present. But the present will go to my physical students today. Online, I've given you guys so many presents. So this present of 1,000 bob will go to my physical students, one student here. The one will be able to get it right. And then number two will go out of their way to show the other students how to do this question. So you're looking for two characteristics there. And then the online students, the next question will be yours. Yeah, yours, of course, it is your speed that will save you. All right. So I stop recording temporarily. All right. So then we are doing this question of December 2022, question number 3A. So December 2022, question number 3A. So we are told there are two farms, A and B, operate in the same industry. The two farms are similar in all aspects except for their capital structures. The following additional information is available. A Limited is purely financed through equity which is the same as ordinary shares. B Limited is financed using 50 million ordinary shares, and they have a 50 million debt, 7% debentures. The EBIT are 10 million for both firms. These earnings are expected to remain constantly, or rather constant, indefinitely. The cost of equity in A Limited is what percentage? 10%. The corporation tax rate is 30%. So using Modigliani and the Miller model, determine the following. Number one, the market value of A Limited and the B Limited. And then number two, the WACC. So first of all, we value the unlevered organization. And remember, this will be what year 2 because of the corporation tax given there. So if it is MM2, I will remember those basic steps. First, give us value of unlevered farm. How do we get value of the unlevered farm? If it's, ladies and gentlemen, this is MM2. So we'll talk of EBIT. We take away what year tax, and all this money will belong to equity holders. Because you see, value of unlevered, there is no interest, isn't it? Because there is no debt. So you divide by K like that. So as this examiner given us EBIT, yeah, they told us that EBIT for both organizations, each organization is 10 million. Taxation is 30%. All over Q, they told me in note number 4 that the cost of equity in A Limited. And remember, this A Limited happens to be what here unlevered. It is 10%. So then this one ended giving you guys what amount? 70 million. Great money. If you get this kind of money today, you may not be coming for the AFM classes. Yeah, so that's number one. Number one, they wanted us to give the market value of A and the B. How do we get market value of B? B is levered farm, isn't it? Yeah, so it will be V plus DT. And the V is 70 million. The debt taken up by farm B is 50 million, isn't it? 50 million times tax. Tax, which they have given me a figure of 30%. So this one ended up giving you what here? 85 million, 85 million. So this gives you 85 million. So having gotten this, I'm so sure I know the next step will be to break down this. So go ahead and give us a breakdown of the value. Give us a breakdown here. So give us a breakdown. Give us a breakdown. So breakdown, when you are doing the breakdown, you know that farm value will always be equal to debt plus what here? Equity. So remember, we are doing breakdown for the levered farm. So the farm value, total farm value is 85 million. Fortunately, we know the debt. Debt is how much? 50 million plus what we call equity. Meaning that equity will be 85 million minus 50 million. Which is what here? 35 million. Which is 35 million. Like that. 35 million. So therefore, the weights, like now weight of equity will be 35 million over what? Over total value, isn't it? 85 million. Which will end up giving us what figure? 0.412, You can see at times these examiners here, they pick those, that's my textbook. They pick questions from there, they just multiply by 10, day. Yeah. So they come and they give us here weight of debt. So weight of debt, it will be 50 million, because we know the debt, over 85 million, which will end up giving us the 0.588. So up to there, all of us, are we able to follow? Great. So they've been able to get these weights. After getting the weights, I know what defeats many students is the KEL, cost of equity over levered farm. Like in this question, this examiner was a little bit easy. He even never gave you the cost of equity of B. So at least that way, students would have guessed that they needed to do it. If I were the one, I would have given you cost of equity of A is 10%, and the cost of equity of B is also 10%, for me to see whether you'll be able to remember that cost of equity of a levered farm, given a question is fake, that you must always use MM2 KEL formula. Always. MM2 KEL formula. 𝐾𝐿 formula always. So 𝐾𝐿 then will be equal to what here, somebody? KU. Aha. Plus, in this case here again, KU. Minus who? Into debt over what here? Equity, which we take away what here, somebody? Tax. We take away tax like that. So meaning that our 𝐾𝐿 will be equal to KU. KU, what is KU here? Cost of equity of unlevered farm. We have an unlevered farm known as A, which is 10%, isn't it? 0.1 plus 0.1 minus KD. Any debt instrument given, they'll be able to pick its interest rate. So the interest rate of the debentures is 7%. So minus 0.07 times the debt. Debt. What do we have here as debt? 50 million. I can't even forget the millions, over 35 times the 0.7, isn't it? To deduct tax there. Which then will end up giving you what, kel? So here we shall be able to give them some time. They compute themselves, all right? Yeah, because there are no copycats here, we shall compute ourselves. We shall compute ourselves, get this scale, So we have Marion 13%. 13%. Marion, she's getting 13%. Are we able to get that 13% all over us? Yeah. So you'd have gotten my 1,000 if you discuss with somebody, If you discuss, but now you never discuss. So I give you half price. You never discussed with anybody. Goretti is getting 13%, right? 13%. Now, ladies and gentlemen, after getting that, I will be able to get what we call wakaka. We give them wakaka for the levered farm. So wakaka. So wakaka is weight of equity, cost of equity, plus weight of debt, cost of debt, into 1 minus what here, somebody? Tax. So weight of equity, already we have this as 0.412. Cost of equity, we got it here as 13%. Weight of debt, 0.588 times cost of debt, which is 7%. Yeah, cost of debt is the interest rate of the debentures. Times 0. What there? Times 0.7. Is that okay? Times 0.7, which in this particular case, then will end up giving us what figure? Which will end up giving us what figure? That is how they were able to get the 8 point something, isn't it? 8.24. A1G 8.24%. 8.24%, like that. 8.24%, like that. All right, ladies and gentlemen. So then, having gotten that, we must always read the question. The examiner wanted us to do two things here. If you read here, the examiner wanted us to get the market value of A and B, that we have done. WACC of A and B. So whatever you have here is WACC for which one? For B. How about WACC for A? Remember, this will be the WASHU, weighted average cost of capital of unlevered farm. Weighted average cost of capital of unlevered farm, which will be the same as what, ladies and gentlemen, here? KU, which was what here, somebody? It was 10%, isn't it? 10%. You don't have to do a summary if the examiner has not asked you for that. We shall always be precise, just like the military who are on some shooting range. Precision is key. Precision is key. The guys who never got it right, where did you go wrong? Where did you go wrong? Is it in ascertainment of the kel? Or you were to get it right, were it not for limitation of time? It was time issue, It was time issue. And whenever you want then to trick you, my students, a little bit, whenever you want to trick you a little bit out of this is how we will normally set this question. Yeah, look at April 2022, question number 3B. April 2022, question number 3B. So whenever we want to trick our students a little bit, just a little bit, just a little bit, just a little bit, this is how we shall do it. This is how we shall do it. So we have here April 2022. April 2022, question number 3B. Question number 3B. Let me know once you're able to get this unlevered farm. So we have here April 2022, question number 3, boy. April 2022, question number 3, boy. That is how we try to confuse students using these models of MM1 and MM2. There was a slight error there, which I'll not want to mention. I would want to see how you'll handle it. Yeah, so April 2022. First of all, have you gotten the question? Do you have it? An unlevered farm? No question. So these past papers are confused, eh? An unlevered farm. At least Whitney has gotten. Ah, great. Mutai has also gotten, eh? So we are told here an unlevered farm operates in a perfect market and has EBIT of 4 million. The required return on assets of farms in this industry is 16%. Assume that the farm issues 10 million worth of debt with a required rate of return of 14.5% and uses the proceeds to repurchase outstanding shares. There are no corporate or personal taxes. Great. So market value and required rate of return of these farm shares before the repurchase transaction according to MM1 proposition. And then number 2, according to MM2 proposition. So I would want to leave you with that question, ladies and gentlemen. Today I've been on the road for most of the day, so I would want to end my class there, but you have work to do. You have work to do. So it has been a pleasure hosting you, but I need to give you a present before I go, right? So please finish that question. Thank you so much. Online ninjas, I hope you have picked something from this. The online ninjas, and today you have been quite a number. Yeah, I hope you're not going home empty-handed. Great. So thank you so much. Bye-bye.